The index shows no clear direction, yet sentiment is unusually sensitive. Even the slightest fluctuation gets blown way out of proportion. In today's episode, I'll walk you through all the key factors that influence the market this week, so you'll know exactly how to navigate the market right now. Hi everyone, I'm Peter. Today is Saturday, January 17th, 2026. The stock market just wrapped up a very exhausting trading week. The three major indexes closed slightly lower overall, but the process was anything but gentle. Sentiment swung wildly, and the pace was extremely unstable. Many traders ended the week worn out, without really understanding where the issues came from. Looking at the results, the S&P 500 fell a total of 0.34% this week. The weekly candle still remains above the 5-week moving average, meaning the medium to long-term trend hasn't been broken. But if you zoom into the daily chart, the problems start to show. The index broke lower repeatedly. Short-term structure is clearly weakening, and that final drop, it was almost dragged down forcefully by Nvidia. The reason behind this is actually quite simple. The market pace is volatile, capital flows uneven, institutions deliberately create support or suppress the index, and retail sentiment gets amplified. This creates intensified daily swings. In this environment, every short-term trader who thinks they've caught a breakout can get hit by last-minute volatility, making blindly chasing highs extremely risky. To make matters worse, the S&P 500 has tried and failed multiple times to break through the 7,000 level. This has put the market in a highly sensitive state. Any small news can get overinterpreted, sentiment flips quickly, and bulls and bears get shaken out repeatedly in a short time. The market lacks clear direction, yet individual stocks are moving violently, which drives capital away from index betting towards sector and individual stock plays. In the short term, opportunities are more likely in small caps and thematic stocks than in the index itself. Speaking of sector and individual stock opportunities, the financial sector is a great example this week. Look at JP Morgan and Bank of America. Their post-earnings performance was weak, temporarily dragging the entire sector down. In this situation, many would think financials are dead in the water, but the market quickly reversed. The macro side continues to influence the market as well. Several Fed officials recently stated that the labor market is stabilizing and inflation pressures remain. The market currently assigns a 95% probability that the Fed will keep the benchmark rate unchanged in January. This high certainty limits short-term upside for high beta assets and also suppresses panic selling in low-risk assets. In other words, the market action you're seeing is largely capital searching for yield under a constrained rate outlook, not because the broader market suddenly got stronger. Adding to this, next week has only 4 trading days. U.S. markets will be closed on Monday for a federal holiday, leaving just 4 days for trading. At the same time, all eyes are on the upcoming PCE inflation data, which will directly influence the Fed's future policy outlook and have immediate effects on liquidity and price volatility in higher-risk assets. There's also a potential major event next week. Trump will lead the largest U.S. delegation ever to attend the World Economic Forum in Davos, Switzerland, from January 19th to 23. Attendees will include top executives from Microsoft, Nvidia, Alphabet, ExxonMobil, and heavyweights from Wall Street like Jamie Dimon and Ken Griffin. The market widely speculates that Trump might release signals regarding the next Fed chair during this window, which could become a significant short-term market disruptor. Now let's talk about silver, which has been extremely hot recently. Retail investors have been frantically buying silver ETFs, with $920 million in total inflows over the past 30 days. On a single day, SLV saw $69.02 million come in. Silver is up 28% year-to-date and has surged 210% over the past 12 months, a textbook example of sentiment-driven catch-up buying. At the same time, retail investors are heavily shorting the 2x leveraged ETF ZSL. This ETF dropped 87% last year, and in less than a month this year, it's down another 42.5%, when both long and leveraged short ETFs are being frantically traded by retail. It shows the market is in a high volatility phase, not a high certainty phase. What's coming next could be sharp spikes followed by fast drops, or back-and-forth swings hitting both long and short positions. Without strict risk management, investors can get cut easily. Looking at utility power stocks, they had a brutal week, but this wasn't due to operational issues, it was policy repricing. Governors from 13 U.S. states signed agreements with the White House to cap wholesale electricity prices, locking PJM grid capacity auction prices for the next 2 years at around $329 per MW. However, this policy deal also brings long-term structural benefits. The federal government is encouraging tech companies to sign long-term power purchase agreements, usually 15-year contracts. Tech companies will pay even if they don't use the power and take on grid expansion costs. This means utility companies don't need to spend their own money upgrading grids, and their cash flows and balance sheets become more stable. Their profit model is shifting from short-term cyclical swings to long-term predictability. In other words, CEG and VST's short-term stock drops are just the market quickly repricing the policy expectation. The core logic hasn't changed. AI data center electricity demand is strong. Nuclear power is scarce and irreplaceable, and long-term profitability remains solid. If the stock drops further to the $280, $295 range, that's a retracement from the April low last year. Technically, CEG and VST briefly fell below the 200-day and 250-day moving averages, then bounced back above the long-term averages by the close. The first touch of long-term moving averages often acts as support. From a short-term perspective, today's decline shows some degree of emotional overreaction, especially right after the price cap agreement was released. The market simply needs time to digest it. Meanwhile, storage stocks are strengthening again. This week, Micron Technology Director Lou Diane bought a total of 23,200 shares across 3 transactions, spending around $7.82 million. Liu, formerly chairman at TSMC, had just joined Micron's board. This is his first major purchase, and he bought at a high stock price, signaling strong confidence in Micron's growth. A few days ago, Micron's VP said that AI data center demand now accounts for 50–60% of the DRAM market, completely reshaping supply and demand. The industry still faces capacity shortages, and new production lines take years to stabilize. The tight memory market is expected to last until around 2028, meaning Micron's good performance days are still ahead. Any short-term pullback in stock prices is actually a chance for investors to get in. SNDK keeps hitting new highs, and each pullback to the 10-day moving average is absorbed by buyers with almost no visible selling pressure. This shows capital continues to flow in, not exit. Turning to crypto, the market saw a phase recovery this week. Bitcoin rose 5.4% this week, rebounding roughly 20% from its November low. Other cryptocurrencies recovered as well. This rally coincided with the U.S. Senate Banking Committee preparing a key vote on the CL-Aradi crypto market structure bill. Originally seen as bullish, the vote's delay dampened market sentiment. Coinbase also experienced a short-term panic sell-off, with its stock down about 44% since mid-October last year, a mid-cycle correction in a bull market. The decline was mainly due to bearish Bitcoin trends, reducing trading volume, ETF fund outflows, and analyst revisions, lowering 2026 EPS forecasts by roughly 27%. While Bank of America upgraded INE to buy, noting the downside has largely priced in the bad news, the stock's ability to resume an uptrend still hinges on Bitcoin breaking $100,000. Once Bitcoin stabilizes, off-exchange capital may flow back into the exchange sector, potentially lifting Coinbase and related crypto stocks. To summarize the current market structure, the broader market lacks direction, indexes struggle to break key levels, and short-term volatility is rising. Small caps and thematic stocks see active capital, concentrating short-term opportunities in differentiated sectors. Capital flow is clearly deviating from the major indexes, making trading rhythm and risk management more critical than ever. Space stocks have been surging recently. Small Moon Launch jumped 10.7% today, ASTS soared 14.34%, and RKL Bay gained 6.1%. Big tech and major index stocks remain relatively stagnant, naturally pushing capital into small caps searching for action. The logic is simple. When the broader market loses direction and large tech consolidates before earnings, small caps and thematic stocks become a safe haven for capital. Overall, the market isn't about who is more aggressive right now, it's about who can stand firm the longest, control your positions, manage radiantly, wait for a clear trend. Looking back at the end of the year, you'll realize that these tricky points today could actually be long-term, low-entry opportunities, as long as you hold patiently, avoid chasing highs, and don't leverage recklessly. Things are actually fine.